Good morning, everyone. Today we will examine the case of Metalgesellschaft AG, a prominent German industrial conglomerate and its subsidiary, Metalgesellschaft Refining and Marketing, or MGRM. In the early 1990s, MGRM, which was heavily involved in energy trading and derivative, implemented a bold strategy to hedge against volatile oil prices. However, this strategy led to a catastrophic financial crisis when market conditions shifted unexpectedly. MGRM approach resulted in losses exceeding 1.3 billion, showcasing several flaws in their risk management. In our presentation, we will cover the derivative product use, the amplification of risk, the specific failures in their strategy, the consequences of this failure, and the critical lesson that can be drawn from this case.
MGRM strategy involves selling long-term forward contracts for gasoline and heating oil, committing to deliver these products at fixed prices for up to 10 years. To hedge against potential price increases, MGRM took long positions in short-term futures contracts using a stack and roll approach. Each month before its expiration, MGRM rolled them into new near-month contracts to maintain their hedge position. This strategy was based on the assumption that the market will remain in backwardation, where spot prices are lower than future prices. Hence, gains from the futures contracts would offset potential losses from the forward contracts. To further diversify their hedging, MGRM also entered into fixed for floating over-the-counter energy swaps, covering an additional 110 million barrels. The mismatch between the short-term futures and long-term forwards created significant risk. Basis risk emerged due to differing maturities, and cash flow volatility increased because futures contracts required daily mark-to-market settlements. These risks were amplified by the reliance on a fixed 1-to-1 hedge ratio and an assumption of predictable market behavior.
In 1993, the oil market experienced a dramatic shift as prices fell sharply, driven by OPEC's inability to cut production. This led to a contango market structure where future prices were higher than spot prices. MGRM strategy faltered as they faced substantial losses on their futures contracts, while their forward contracts, though increasing in value, did not help with the immediate liquidity crisis. The falling oil prices triggered significant margin calls on MGRM's futures positions, creating a severe cash flow issue. Despite the gains from the forward contracts, MGRM could not cover the margin requirements, leading to over $1.3 billion in losses. This financial strain forced the company to seek a $1.9 billion bailout. This crisis also led to a major overhaul of the company's management and its eventual acquisition by GEA Group in 1999.
The Metalgesellschaft AG case offers several detailed lessons in risk management. First, aligning hedging strategies with actual market exposures and conditions is critical. MGRM's strategy failed because it relied on a fixed 1-1 hedge ratio, assuming the market would remain in backwardation. However, when the market shifted in the contango, this rigid approach led to overhedging, amplifying losses instead of mitigating them. Second, the importance of liquidity management cannot be overstated. MGRM estimated the cash flow requirements associated with daily margin calls on their future contracts. When oil price fell, they faced several liquidity shortages, unable to meet their immediate cash demands even though their long-term contracts remained profitable on paper. Third, flexibility and risk management strategies is essential. MGRM's strategy was too static, lacking the ability to dynamically adjust to changing market conditions. A more flexible approach, such as adjusting hedge ratios based on real-time market data or employing a diversified mix of hedging instruments, could have mitigated the losses. Additionally, having contingency plans in place to manage unexpected market shifts would have provided a safety net, allowing the company to respond more effectively to the crisis.
If we were managing MGRM, our approach will include a dynamic hedging strategy rather than a fixed 1-1 ratio. We will adjust the hedge ratio based on market condition, reducing exposure in contango market to minimize losses and increasing exposure during backwardation to capitalize on rising prices. Additionally, optimizing fixed for floating swaps will reduce reliance on frequent futures contract rollover and stabilize cash flow, as swaps do not require daily settlement. Rigorous risk management practice, including continuous market monitoring and counterparty risk management, will be essential.